With compromise in the air in Washington, we can finally get back to talking about earnings. And speaking of earnings, who would have guessed that the banks would actually be reporting great numbers this earnings season? And I'm not the only, just talking about the big guys. I'm not just talking about Bank of America, which did deliver a good quarter. No, I'm talking about the kind of banks that I tend to favor above all others, the regionals. Just this morning, KeyCorp, that's K-E-Y for you home gamers, reported some terrific numbers, and the stock jumped about 2% on the news, rising to over $12, where it's now roughly 50 cents away from its 52-week high. Before we get into the nitty-gritty, let me give you some context. The Cleveland, Ohio-based Key is one of my favorite banks out there, over 1,000 branches across 24 states in the Midwest, the Northeast, and Pacific Northwest. I like it so much that we own it for the charitable trust. You can follow along at actionplus.com. Now, this morning, Key delivered a 5-cent earnings beat inline core revenues and net interest margin. What the bank makes the difference between the low rate they pay for you for deposits and the higher interest rate they charge for loans that only declined by 2 basis points, much better than the 5 to 10 drop that the analysts were all expecting. Meanwhile, the company saw a 5% increase in loans and leases, dramatic credit quality, net charge-offs for bad loans at their lowest level since the beginning of 2007. This is a very well with a lot of excess. They're returning aggressively to shareholders. The quarter alone, Key bought back 16 million shares, 2% of the share count. Stock has given you a 30% gain since the last time we spoke with the CEO back at the end of January, double the performance of the S&P 500. So let's check in with Beth Mooney. She's the chairman, president, and CEO of KeyCorp. Learn more about the quarter and where her bank is headed. Ms. Mooney, welcome back to Mad Money.
Thank you, Jim. Glad to be back.
Well, first of all, congratulations on what I thought was the best net interest margin quarter of all the banks that I've seen. How are you able to make so much money off of the deposits when everyone else is shrinking so fast?
You're right. We had a very strong net interest margin. We did not see the contraction that was predicted or has been seen in many other banks, and it's really a combination of managing our liquidity levels, reducing the cost of our interest-bearing liabilities was a huge lever for us, and just managing our loan yields has really brought in a solid NIM performance for us.
Well, you also did, just to speak of lending more, loan growth driven by an 11% increase from the prior year. Commercial, financial, and agriculture are just your areas of the country are booming. Are you winning share? What is happening?
Jim, we talked about that last time I was on, and that is a very intentional strategy of ours. We see it evenly across our markets, but what I would tell you really is the driver is we're taking market share. We have a very distinctive business model where we're going into targeted client segments and targeted industries with a full array of products, and you can see it in our 11% year-over-year commercial loan growth. We are leading the peers, well outpacing, and that's where we're winning business and taking share and expanding relationships.
Which are the, because you do have a very big footprint, which are the areas that you are taking the most share and which are growing the best?
You know, what's interesting is I would say it's more about size of company than geography this particular point in the cycle. We see our larger companies borrowing and being willing to entertain a proposition like Key because of the wide array of products we can give from debt, equity, M&A advisory, as well as lending and treasury management. And some of our smaller to mid-sized companies are being a little more cautious at this point in the cycle because things are so uncertain. So we really see growth across the franchise, but canted a little bit to some of our larger middle market companies.
Okay, I know that Chris Gorman in the conference call talked about the idea that a couple of clients were, he used the term, very cautious. Do you think there's any possibility that that if we really do have a compromise here, that some of that caution could evaporate between now and year end and could produce some more loans?
Well, I will tell you that we, as I said, have been growing through taking share in a year where I would say the tone of our consumer and our business clients has been cautious all year. The level of uncertainty in the environment, a slow growth expansion, tax uncertainty, uncertainty in Washington, it has been a cautious environment all year. So I don't think a resolution today in Washington, which we are all very hopeful indeed get the votes in and do the right thing today, will not necessarily unleash any pent-up demand. I think it's just a steady-as-she-goes sort of economy that we need to continue to outperform in.
But there is one part of the economy of which some of your geographies hit, which is oil and gas. And I have to believe that you are seeing commercial and residential loans being given in those areas just because there is a boom going on.
There is a boom, and particularly when you look at Marcellus and Utica shale, those are huge, and we are squarely within those markets. So natural gas, oil, energy, housing prices, that is indeed all coming back. So I do think the underlying fundamentals in this economy are getting stronger and stronger, even if it is slow growth.
Ms. Mooney, you're one of the few people who can actually explain the multiplier effect of these different projects in oil and gas. When someone builds a pipeline, when someone starts drilling, what are the ancillary loans that you get at KeyCorp?
We get everything from the consumers and the homeowners who they're drilling on their land, leasing their land. You get the workers coming into, I call it, if you think of the Alaska pipeline, the workers actually moved there because the jobs are there. It brings in housing, it brings in ancillary services, and not to mention that we are lending not only to the companies that are providing the drilling and the exploration, but we're also very much supporting all the support businesses around it. It is a spillover effect, and as you look at some of these areas that have the shale and the natural gas, it's adding multiple points to the state's gross domestic economies.
Right, that's terrific. You're the first person who's come on and actually said that as a banker, which is great. Quarter, I see that you closed 8 more branches. At what point can Key go on the offensive and start opening branches?
Jim, we've actually been doing a combination over the last couple of years of opening and closing. I look at it as just prudently looking at our branch infrastructure and saying kind of what's the old bottom 10%, where can you get more efficient and take out some capacity that's not really adding value, all the while looking at how do you invest in digital, mobile, where could you open a new branch that would be good for your clients. So I think it's just good old-fashioned channel management to think about opening and closing, and it has helped us become more efficient.
Oh, and your recoveries. Net recoveries up $12 million or 41% for the prior quarter on a linked quarter basis. Why have you had such success? That is a remarkable figure.
I will tell you, credit quality was a real standout this quarter. We had the lowest level of net charge-offs we've seen since the first quarter of 2007, and some piece of that was in recoveries. We had several loans. Again, we are at the point in the cycle where as loans are recovering, we are getting some paybacks and recoveries because we have seen companies recover to the point where the value of the collateral is coming back.
All right, one last question. If we do see rates, say 10-year goes to 3.5, 4, would you be in one of those banks that actually would begin to make more money?
You know, we are actually more tied to the short end of the curve. You know, 70% of our loan book and our balance sheet is tied to either overnight or 30-day rates. So we actually would look for the short end of the curve to go up for us to make more money, but the long end of the curve going up would mean that the Federal Reserve is more comfortable with this economy. They're willing to start tapering, and I think that would be a good thing for the markets and the economy.
Well, Ms. Mooney, you delivered. You're a regional bank that has been a star in this country, and I thank you so much for coming on Mad Money.
Thank you, Jim, and thank you for your support of Key.
Of course. Okay, that's Beth Mooney, Chairman, President, CEO of KeyCorp. Look, you were always saying to me, hey, how about a $12 stock? How about a $10 stock? How about a $15 stock? How about Key? These were great numbers. David Kramer.